they need to make sure they're ready for the fundraise. So they need to understand how much money they are raising, for which period of time, and what they will be able to deliver during this period. Startup needs to understand its operational costs versus the revenue they're generating. And of course, all documents needs to be in place. So if you do not have a legal entity and you are raising an equity, start setting up a legal entity, start opening the bank account. You will not be able to fundraise if you're fundraising in the capital. You will not be able to fundraise without the bank account. It might take much more time than you are expecting to. So getting ready in terms of the legal, preparing all the documents, preparing the data room, just super simple one on the Google Sheet at incorporation documents and cap table, financial model, and pitch deck. This is basically everything one needs at the very first stage. This is it. Good question. I do not think there is a lot of difference between them. Just the only thing that companies need to pay attention to when they are fundraising, that Web3 is the very specific industry, and they need to go to the investors who have some experience in Web3. For example, one can find a lot of agnostic VCs in Web2. So agnostic, I mean VCs investing in pre-seed, seed software stages. Usually Web3 does not fall into this category. So piece of advice number one, go to the investors who really understand what you are building. There are not so many VCs in general in this space, so make sure that the person you are talking to really understands what is like Web3, blockchain, crypto, wherever industry you're operating. Point number two, as in any industry, there are some specific metrics that are applicable to Web3 company in each sector under this Web3 category. So make sure that you are speaking this language and disclosing the parameters that are applicable for the industry you're operating in. Founders should avoid getting toxic investors on board. So especially at pre-seed, founders need money so much that they are ready to take on board literally anyone who is ready to place some funds into the startup. Not everyone, but still some of the founders. And here come the cases when they take some toxic angels or toxic VCs on board, and later when the company finally starts making its first sales and starts growing, these investors, they really prevent company from growing. And so make the background check on the investors. Read some materials on how much the company needs to be diluted at every stage of investment before taking investment. So raising money and getting diluted for 45% at pre-seed stage means that like your company will basically not be able to raise any further investing. To speak about presenting this at the pitch deck. In the pitch deck, this would be that market slide with the 10-cent sum. Their idea is just to make calculations from bottom up and up to bottom, and find some intersection between these figures. So how the proper market calculation should look like, you need to understand your very clear customer profile. So for example, you're building some product for white females aged from 35 to 37 who are having annual payroll up to $1,000 in the USA. That's kind of a definition of pretty much clear customer profile. And then you're applying this customer profile description to the product that you are selling and to the current usage of this product in this particular market. And based on this, you will be able to understand what is the total market coverage in that particular area or geo that you're operating in, and what would be the percentage of the pie that company is able to take. And when investors are looking at pitch decks, they, based on the figures and on the ways of calculations, they very clearly see if a founder is understanding, if a founder understands whether there is a market or not. The next recommendation from my side would be build the financial model. I know that many founders really avoid building it at the first stages, that I don't need it, and it's only for investors. We do know that the only right thing about your financial forecast is that it is wrong. everyone knows that. But when one is building the financial model, the very simple one, like just 20 rows in Excel, founder understands how much the growth rate will be increasing, what would be the operational costs, what would be how the payroll expenses will be growing or declining based on the business model. And when founder builds this financial model in Excel, it really helps to structure the thoughts and have everything in front of their eyes. So my recommendation would be to make it. And then, of course, like I do not see why founders should not share it with investors. That will also help us to make the decisions faster.